You know, like you had a good business at Kodak and your family had all their money in Kodak, and then what happened? Or you own Xerox, and what happened? Then you own the best business in Ukraine, and then there's a war. That happened. Right? I could give you 10,000 examples of risk factors that destroy wealth. So you've got that, 450 trillion on one side, and then you've got 1 trillion digital capital. It's like, well, I had a building, I get rid of all the things that make the building a problem, and I make it an invisible, immortal, indestructible, teleportable digital building.
Financial engineering type strategy is often referred to online as the infinite money glitch. But I wonder if it is infinite or not.
It's not a money glitch. It is a digital transformation of the capital markets. When you have a system that moves from a higher energy state, a more disordered state, to a lower energy state, lots of energy gets given off. Think of steam becoming water. Like, is it a money glitch? It's just steam becoming water and it condenses. What happens when water becomes ice? It's not a heat glitch, but heat. What happens when you add heat? The ice becomes water, the water becomes steam. So if you look at the capital markets, you've got $800, $900 trillion of wealth in the capital market. And you've got this wealth, you've got people invested in all these heterogeneous assets. Why do 98% of the companies in the S&P 500 not perform, right? How come 1% of all the returns come from like 7 companies, right? What I talked about with, if you study the convertible bond market, someone issues a convertible bond, it takes them 5 years for the investors to figure out whether it worked. And then when they come up with a new convertible bond, it's a different credit proposition. It's very inefficient, right? If you think about preferred stocks, very inefficient. Junk bonds, very inefficient. Private credit, very inefficient. You know, fixed income, people get very low yields. What if I'm getting this yield and I'm taking all this credit risk and counterparty risk? So of the 900 trillion in capital in the global capital markets, half of it is just long-term store of value, long-term capital. You know, that is pure capital. People with money just want to keep their money. Rich just want to stay rich. I give you an organization $1 billion in the endowment. You just want to not lose the $1 billion.
Precisely.
Right? So that 450 trillion is invested in buildings that are rusting. It's invested in cars, it's invested in fleets, it's invested in things that suffer from 20th century risk factors. Credit default, war, tariff, tornado.
Tax.
You know, like you had a good business at Kodak and your family had all their money in Kodak, and then what happened? Or you own Xerox, and what happened? Then you own the best business in Ukraine, and then there's a war. That happened. Right? I could give you 10,000 examples of risk factors that destroy wealth. So you've got that, 450 trillion on one side, and then you've got 1 trillion digital capital. It's like, well, I had a building, I get rid of all the things that make the building a problem, and I make it an invisible, immortal, indestructible, teleportable digital building.
That'd be cool.
Okay? Well, that's what Bitcoin is. So this thing that people think of as a glitch, it's not that, it's energy flowing from a steam state, from highly disordered, inefficient, bouncing into each other, into a more ordered state, right? It's moving from you're in Africa, I give you $1 billion. I say, go invest in any real estate in Africa, in anything you want, any country, hold it for 30 years. There's not a single thing, you know, that you would want to invest in. And I say, well, you know, would you rather own $1 billion of real estate in Africa or $1 billion of real estate in New York City? Well, you can see you'd rather swap the New York City risk for the Nigerian risk. And then I say, well, would you rather own $1 billion of real estate in New York City or $1 billion of Bitcoin or $1 billion in Cyber Manhattan? There's no mayor in Cyber Manhattan. There's no property tax in Cyber Manhattan. There's no storms. There's no weather in Cyber Manhattan. Everybody lives forever in Cyber Manhattan. You can teleport Cyber Manhattan 60 times a second. You can program it as an AI. It's like, so what you see is it's not a glitch. It's simply capital flowing from a disordered economy. Like in Argentina and Nigeria, they have hyperinflation. Okay, so if I happen to be there and I'm selling pesos and buying dollars, and the peso used to be 1 peso to the dollar, and today it's like 1,400 or 1,200 pesos to the dollar. Was that a glitch? Like, was it, or
was that just the market at work?
That's basically the free market. It's capital flows to where it's treated the best. And so if I have capital, in Argentina, I would put it in the U.S. And if I have capital in the dollar, let's take the dollar. 100 years ago in Miami Beach, an acre of land on the waterfront cost $10,000. Today, $10 million. The dollar lost 99.9% of its value against real estate, waterfront property in Florida. Okay, is that a glitch? Right? And the peso lost 99.9% of its value against the dollar in 20 years. Is that a glitch? That's really just capital flowing from a weak asset to a middling asset to a stronger asset. And Bitcoin's advance is capital flowing from 20th century analog assets, financial and physical assets, to the 21st century digital economy. So as this becomes a fraction of the 20th century economy, the difference between the cost of capital in the Bitcoin universe, which is 50% right now, and the cost of capital in the dollar universe, which is about 12 to 14%, look at, basically that's the return of the S&P. So the S&P sets the cost of capital for traditional, conventional assets, and Bitcoin is the opposite. And so Bitcoin is like 3.5 times the S&P, and it's also 3.5 times the volatility. Look at devol, Bitcoin volatility, 55 versus the VIX. And so if you look at the two, it's not a complicated thing. It's a thermodynamic idea that any physicist will tell you, this is a hot fluid, this is a cold fluid. I pull up the gate and I mix the fluids, and how hot is the bathtub? It's somewhere in between, right? The temperature's it's going to be in between scalding hot and freezing cold. And in the middle, if there were some ice cubes in this one, and I release scalding hot water here, some of the ice cubes are going to melt, but you're going to end up with a warm bath, with the exception that there's always going to be, if you look out 10 years, instead of 50 vol versus 15 vol, maybe it'll be 45 to 40 to 38 to 36 to 32 to 28. This volatility is coming in. This ARR is coming in. Now this comes up because what happens when Apple and Google and Microsoft and Facebook or whatever, when they buy Bitcoin? What happens when you could take the bottom 98% of the S&P 500? If they bought Bitcoin, their performance would start to approach the big tech. And so the performance of the S&P index will move toward Bitcoin as they put Bitcoin on the balance sheet. Bitcoin performance will move toward the S&P as we move from a 100 to 1 ratio to a 10 to 1 ratio to a 5 to 1 ratio. And these things equalize. But if you understand it as thermodynamics and collapsing into a more efficient energy state, like how is it not more efficient to be able to teleport a building 60 times a second between New York and London? Like that's efficient versus your family made an investment in London 30, 40 years ago and they changed the law last month and now you're going to lose all your wealth. Bitcoin is the digital transformation of capital. MicroStrategy is just a business taking advantage of the digital transformation. But if I was talking to Apple, I would say don't buy back 100 billion of your stock. Buy 100 billion of Bitcoin. It will go to 500 billion. You'll have a $500 billion business growing 20% a year. You'll make 100 billion in investment gains a year. Your investors will look at it and they'll add $1 trillion or $2 trillion to your market cap. And now the company will be valued 60% based upon the operating business, 40% based on the balance sheet, right? And the risk will shift because the risk in a conventional company is the balance sheet's worthless and the company's valued based upon the P&L, And so if you make $1 billion a quarter, I basically value it at 20 P to E. So I take the quarterly result, I multiply by 80, and I say, oh, you're worth $80 billion because I took $1 billion and multiplied by 80, and the balance sheet's worthless. But the next quarter I say, well, my billion went to 0. Well, that's 80 times $1 billion change. You've got a massive whipsaw. That's why these company stocks crash. If the company had $40 billion of tangible assets on the balance sheet, and it was that puts a floor right on the equity, and really what you want is you want a well-balanced company where, it's like Harvard University or Yale. They're not valued based upon the earnings of this semester of freshmen entering Harvard. They're valued because they have $18 billion in the endowment, you know, and if they close the university, they're still rich. They have $18 billion in the endowment. So MicroStrategy is just pioneering, it's kind of common sense. Your family wouldn't give away all your money and just say we're going to work harder. And a university wouldn't give away all its money and say we're going to raise tuition, cram the classes, cut the teacher's salary, and work harder. But conventional wisdom in finance is your company ought to dividend out its capital. It ought to buy back its stock. It shouldn't actually hold any capital on the balance sheet. And it should just raise its prices and tell its employees to work harder and cut its cost. And that, in a nutshell, is why 99% of the companies in the world underperform the Magnificent Seven, and why they all could benefit by just adopting Bitcoin as their treasury reserve standard.
How should investors analyze MicroStrategy? Because if you mentioned that, to give you a metaphor, MicroStrategy is the tap to that capital flow, as you mentioned. There's nothing else like that. Like, are you a Bitcoin bank? Do we value you similar to, do we analyze you similar to a bank? Or do we, I've seen a simplification perhaps as analyzing MicroStrategy like a REIT, like a real estate investment trust, but...
So if the company gets to $50 billion of Bitcoin, and if Bitcoin goes up 20% a year, the company generates $10 billion a year of investment income. And that compounds 20% a year. So if I said to you, hey, here's a big tech company that makes $10 billion a year, and they're growing that 20% a year, how would you value that?
I mean, through the roof.
You know, my view is Bitcoin's going to appreciate 29% a year ARR for the next 21 years, right? That's
Which
my
takes
base
it to
case.
what? What's the dollar figure on that?
13 million.
Per Bitcoin.
Yeah. Okay, and so what do you think my shareholders think? Well, my shareholders are pretty bullish on Bitcoin, right? There's no one buying MicroStrategy that hates Bitcoin.
No, they're shorting it.
Yeah. So at the end of the day, I mean, the methodology would be figure out what's your forecast for Bitcoin. By the way, you can go to Google, type Bitcoin 24, and you'll find the Bitcoin 24 open source model. It's a 21-year model. You can download it. It's a spreadsheet. And you can put in your forecast for innovation rate, inflation rates, all the asset class, monetizations, demonetizations, Bitcoin assumptions. Supply, all of it. You can put that all in, and you can run your model, and you get your own answer, right? So do that. And then you just got to consider, well, how much capital do you think that MicroStrategy will raise via securities offerings? And after you do that, you decide, are we responsible custodians? And then you create a 5 or 10-year model for our investment income, and you figure out how much income can we generate and how fast can we grow. And of course, all those things are very integrated. And you know, if the more you know about the capital markets, the more enthusiastic you get, because we look and we say the convertible markets are inefficient, the preferred stock market's inefficient, the high yield market's inefficient, the corporate debt market's inefficient, you know, the real estate market is inefficient. So, you know, our view is we kind of want to be the Amazon of fixed income. We want to build a better product direct to a new distribution channel. And you know, I don't blame people for not necessarily understanding that, because sometimes you have to see it. And in the absence of, you know, fair value accounting and the like, and 3-year forecasts, and those, you know, don't exist, it's a lot for people to grasp right now.